Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Marathon Patent Group stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Marathon Patent Group is a patent holding company that is the parent of Unilock, which is known for its involvement in cryptocurrencies. Unilock is a patent assertion entity founded in Australia in 1992. Patent assertion businesses acquire patents. Once they acquire patents, they sue businesses infringing on those patents. Some people call this patent trolling. It is legal for a company to file patent claims without any intention of ever developing a product or service. Let's get started with the model. This is a small cap company, 1.2 billion market cap. They're trading at $23 a share and they have 53 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has negative free cash flow each year. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they also have negative net income each year. Revenue is the sales for the company, and that's up and down. 1 million to 2 million to 1 million back to 2 million. This is the company's income statement. The top line is the revenue, the sales. Their sales peaked in 2018 at 1.6 million. They dropped in 2019 to 1.2 million. And they're almost back to where they were from 2018 at 1.5 million. Their cost of revenue is more than their revenue, so they have negative gross profit every year. They also have operating expenses, which makes them more negative. Then there's interest on their debt and other income and expenses. So of course the company has negative net income every single year. It seems like the goal of the company is to find someone infringing on their patents so they can sue them and generate a lot of money that way. I'm not sure how viable a business strategy this is, but we'll see what happens. This is the company's statement of cash flows, and each year they generate negative operating cash flow. They are improving. It was negative $11 million in 2017. Now it's down to negative $4 million. They only spent $16,000 in capital expenditures, so their free cash flow is almost the same as their operating cash flow. In 2017, the company issued $16 million of stock and $5.5 million of debt. They also issued a little bit more stock in 2019 and the trailing 12 months. Since this company is generating negative cash flow, it needs to get money from somewhere. So it's going to need debt and equity financing until it can generate a positive return. This is a breakdown of their operating cash flow. To calculate operating cash flow, you start with net income, and then you have to add back the non-cash items on the income statement. They had $1.5 million of depreciation. They had $700,000 of stock-based compensation and negative $2 million of changes in working capital. So their net income was pretty close to their operating cash flow, negative $3.6 million. Let's look at their capital structure. $4 million of equity, $1 million of debt, and their WACC is 35%. They're a really risky company, so they have a high WACC. And this is the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $461 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $188 million. We divide that by 53 million shares. And we get a calculated stock price of $3.58. They're trading at $23, so they're trading at a 543% premium. It's a sell according to the model. It was really hard to value this company because they have negative free cash flow and negative net income. Plus their revenue isn't too steady either. There wasn't too much information out there on this company, and there weren't many analysts looking at this stock. But as you know, the stock market is not based off of how well a company's doing. This company is worth nothing because they haven't made a profit yet, but investors look towards the future. If you look towards the future, then you can say a stock is worth infinity. It's really how investors perceive the future. The stock was over $50 back in 2016, then dropped to almost nothing, and then it's come back up in the past few weeks. This company has one of the highest betas I've ever seen, 4.31, so the stock moves more than 4 times the market. And it's gone up a lot in the past 52 weeks, 2,500%, much more than S&P 500. The low was 35 cents, the high was 28.37. And the stock is trading well above its 50-day and 200-day moving average. This is a very liquid stock. 30 to 80 million shares are traded each day. And of the 53 million shares outstanding, 46 million are on float. Only 6% are held by institutions. And it has a pretty high short percentage. 15.5% of the shares on float are shorted. If you invested $10,000 into this company in May 2012 when it started trading, you'd have $150,000 after a couple of years. But if you're still holding on, you're at $28,000. It was in the red for a year or two, then it's come back up recently. A company called 2.1 owns 5% of the shares. Another company owns 5% of the shares. Amplify Investments owns 2%. The CEO of the company, Merrick Okamoto, owns 1.2% of the company's shares. Let's look at their financial ratios. The average PE in the market's 11.7, the median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. Since they have negative net income, they have a negative PE. Price of sales is stock price over sales per share. They're at $7.82. So investors are paying $782 for $1 of sales. Price to book is stock price over book value per share. They're at $331, much worse than the median average. To calculate book value per share, that's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $4 million of equity and $3 million of tangible equity. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They can cover 80% of their current liabilities with their current assets. And of their current assets, they have $694,000 of cash and $800,000 of prepaid assets. They're going to definitely need some more debt or equity to run their business over the next 12 months because they had negative free cash flow and they have negative working capital. Working capital is current assets minus current liabilities. The best way to look at ratios is to compare them to similar companies. I've done videos on Atif Holdings, BGC Partners, both in the same industry as Marathon. And if Marathon has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in everything except debt. They have 25% debt, the average is 30%. And they are bigger in market cap because Atif is so small. They're 1.2 billion market cap. So to summarize, I have them trading at a pretty significant premium, but that doesn't mean the stock can't go up or down. It's really based off of market sentiment. And the reason the stock is going up so much is their link to cryptocurrencies. But they need to start generating some revenue and profits to remain a viable company. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.